With the Fed's two-day meeting underway, Wall Street is on edge. More volatility is expected for the markets ahead. And to help us navigate through it all is Stephen Wieting, the Global Chief Investment Strategist at Citi Private Bank. Hi, Stephen.
Hi, how are you?
Great. Thanks so much for joining us today. So the main drivers in the markets today have been identified as oil, Fed, and the U.S. dollar. Starting with the Fed, investors are keeping a close watch on the word patience as the Fed is in a tightening mode. So the popular trade is out of U.S. equities market to Europe and Japan, where they are easing. Do you agree with that trade?
Well, I think if you look at returns in U.S. dollars, as many of our global investors do, the returns in Europe have been substantially less. Total return has been in the neighborhood of 4% in U.S. dollars. Quite interestingly, the larger equity markets in Asia, where we like markets on an unhedged basis, have had stronger returns. Late last year, we shifted up our allocation to Asia. Now, we like Europe as well, and 23 central banks around the world have followed on easing after the ECB's QE. We do think that we will have a couple years of catch-up recovery in the Eurozone. The problem is that the euro as a currency has been worth as little as 83 cents within the past 15 years. And so we think participating on a hedged basis is a good idea. There's certainly a lot of fear over the Fed. There's policy uncertainty right now. But what is driving an ultimate tightening from the Fed is generally an outlook for strong growth. And that's not to be underrated here. So we have an equal overweight in U.S. equities relative to its share of global market cap.
And you touched upon currency, and the dollar is king and reigning quite powerfully right now at the moment. Beyond the euro-dollar trade, you took a look at the emerging markets, and why did you find Asia more favorable than Latin America when it comes to the stronger dollar?
Well, just as a start, 4 years ago in the U.S., if the oil price plunged, we would be jumping for joy. But the U.S. petroleum trade deficit fell by about 75% as a share of GDP. If you look at the largest economies in Asia, petroleum trade deficits are 2.5 to 6 times as large as the United States. So they're getting declining inflation without harming their domestic industries. They're getting policy flexibility and ability to ease. It will strengthen consumption and growth. In Latin America and emerging Europe, you have a lot of the victims of the oil price drop. If you think about Russia's trading partners, for example, in Eastern Europe, the things that it will take to make the oil price go up again are declines in investment, employment, production. The Middle East is an area that will contract its economy this year. And the things that they will do to boost the oil price are negative for economic growth. And some of the higher debt burdens in external currencies are in Latin America and Eastern Europe. So we've shifted in our emerging markets weightings, where we've generally been underweight emerging markets debt. We've shifted that further up in Asia and down very far in Latin America and emerging Europe.
Thanks, Stephen, because you just went into how the gradual upswing in oil prices might be more volatile and scarier than the dramatic downswing. Are there any near-term opportunities right now regarding oil?
Well, we thought, for example, that there would be some bounce back in oil in January, just in the sense that you can't drop $2 per day forever, and that there was a lot of signs from trading markets that we'd have a bounce. At the same time, Ed Morse, our global head of commodities, very rightly and early pointed out that the sharp rise in energy investment in the U.S. in the last few years had yet to fully play out to rising production and inventories. So we wanted to look at the energy sector generally as a strategic opportunity. In 1986, the oil price fell 60%. Well, there was no recession that did that. And OPEC defended its market share then. And the price came back more slowly than in the last couple of decades when OPEC was very involved. But what happened is that low oil price, petroleum, again, clearly became the world's most economical energy source and led to a couple of good decades of investment gains for energy-related assets like energy equities. And I think that's playing out the same way, but you need more patience than a single quarter time frame. I think you need at least a 2-year tactical window of time or strategic window of time, depending on how you define it.
Stephen, thank you so much for sharing your insight with us today. Stephen Wieting is the Global Chief Investment Strategist at Citi Private Bank. And for The Street, I'm Susanna Lee.